they're going to stay flat. I don't know if they're going to raise rates. I also thought when you bring up Bowman, I also thought it was interesting that yesterday President Trump said interest rates are way too high and we need to get them lower.
Mm-hmm.
So I sense that there's a colossal clash sitting up here between the Fed and Trump. And although Trump can't fire Powell, he can certainly make his life miserable by making a lot of noise about interest rates. And I'm guessing he probably will.
Now, let's talk about this broken system that you referenced earlier.
Sure.
What exactly is broken? How is it broken? And then we can talk about what to do about it.
Yeah, sure. Just at a big picture level, the notion that you have a Federal Reserve Board of 12 people setting the most important price in the world, which is the price of money, the interest rate. Nobody could do it, even if they were godlike in terms of their intelligence, and they're not. They couldn't do it. The interest rate should be set by supply and demand, the supply of capital savings as against the demand for investment savings. That's a market-based economy. I mean, what we've got is like a command and control communism-based economy. It's like the Russians setting the price of grain. And this is why the economy has swung back and forth between booms and busts and bubbles and crashes. Roosevelt accelerated it when he confiscated gold. Nixon accelerated it in 71 when he went off the gold standard. Bernanke accelerated it massively in 08 when he introduced ZIRP and QE, quantitative easing. And so, and with each step, it's gotten more and more unwieldy and more out of control. And the fundamental thesis of the book, the thesis of my investments in general, is that they have to continue printing money or the system will collapse. And not only do they have to continue printing money, they have to continue printing money in ever increasing measure, which is why the COVID response was bigger than the GFC response, and the GFC response was bigger, the one before that, and so on and so forth. So it's a system that's broken, David, and it's either going to get solved as a result of intelligent policy decisions, or it's going to eventually go over the cliff and, fiat's going to fail, which so many times in the past it has.
There's a few things that may point to the other side of the story, which maybe I can ask you to address,
Sure.
Lawrence. So first, if you take a look at, I was looking at this chart a couple of weeks ago, and somebody pointed this out. The number of recessions over the last 100,
go up 40% because the money supply grew by 40% with the COVID response, and their wages haven't kept pace, and so this is what leads to the wealth inequality. I mean, as you and I both know, there are a group of people who actually have figured out how to game the system and benefit from inflation. I mean, the wage earner does not know how to game the system. They can't borrow at 0%. They pay credit card companies 25% to borrow money.
Yeah.
And so they're at a very severe disadvantage to those people who are on the inside who know how to game inflation, actually make inflation, make them wealthier.
The rate of inflation right now is below 3%, though, Lawrence. One could argue it's not that much of an issue anymore. How would you respond to that?
Well, two things. One, it's yes, after it just went up 9%, a year and a half ago.
Yes.
And the overall, it's it's still running. And two, I would also say that, as shadow government statistics has said and shown, and it's demonstrated in my book, to pay the cost of interest. And so a comparable to this would be, this is like this is like the family that has a lot of credit cards and they're making the minimum payments and they're unable to make the minimum payment. So they go get another credit card with a bigger credit limit and they borrow against that to make the minimum payments on the prior ones. So it's a vicious circle, David. That's the problem.
I have to, speaking of the money supply, let's take a look at the M2 money supply. This is a story that may or may not be flying under the radar on the media here, but this is the M2 money supply. And we are once again nearing the peak of the Fed's balance sheet, or not balance sheet, but the money supply in the financial system. This is M2. There's various measures of money,
right.
But we're nearing the peak of 2022, Lawrence. And if you just take a look at it from a annual percent change basis, percent change from a year ago, you can see that it is growing at 2.6% per annum. And I wonder why that is, and whether or not this is a precursor for more inflation.
I think it is. I mean, a billion people know that gold is money, and so it's not going to just disappear. People say, "Well, Bitcoin's going to replace gold," and to some extent, that's true. And Bitcoin's price performance will outperform gold, and that's because it's they both will go up as the money is diluted. I mean, that's a fact. But Bitcoin will, in my opinion, go much faster because it's also enjoying an adoption curve. I mean, gold is not some new thing. I mean, it's been around for millennia. And so anyone who wants to own gold knows what it is and they've already bought it. And whereas Bitcoin, 15 years ago didn't exist, and 10 years ago almost nobody knew about it, and now more people know about it. And so that adoption curve is what's making Bitcoin outperform gold. But they both will go up if fiat currencies fail, and I think there's some chance of that. They will both go up in fiat terms. Now, the problem there is, I mean, we could have $10,000 gold, and we could have $1 million Bitcoin. We could also have, $30 gasoline. So, because fiat, is just programmed to debase.
So the when you say fail, it just means purchasing power of fiat is going down. That's what you mean?
It's just going down, and at varying rates, though, as you and I discussed earlier in this call, or in this conversation. I mean, some years it goes down 9%, some years it goes down less, but there aren't
in hard times.
Well, yes. I mean, so let's get our terms right. Let's define safe haven. I mean, there is no doubt that Bitcoin is more volatile than gold. I mean, that's just a statistical fact.
Yeah.
So, if you want to define safe haven as low volatility, then no, gold is a better asset than Bitcoin. If your only measure is volatility, I mean, if your measure is alpha and potential upside, Bitcoin crushes gold. So, it kind of depends on what you're looking at it for. I mean, one criticism a lot of people have leveled at Bitcoin is they've said, well, it's really just a liquidity widget and it trades like the NASDAQ. When the NASDAQ goes down, Bitcoin goes down. And there isn't a safe haven bid for Bitcoin. And that's a fair criticism because there has been a pretty tight correlation. But I think that will change over time. I think that we're heading into a period where it's going to be seen as a safer haven. And I'll tell you why I say that, David. There's a really interesting chart. I don't have it in front of me right now, but if you run a chart of Bitcoin compared to the long bond, what used to be the safest haven financial asset, the long bond, the 10-year bond, the 30-year bond, right? I mean, as a U.S. Treasury, couldn't default, it was good as gold, so to speak. Well, it's standard. And, there are $900 trillion of global financial assets out there. If you look at everything, if you include real estate, stocks, bonds, cash, etc. The Bitcoin market cap today is 2 trillion. So it's 0.2% of all of the assets out there. So, that's a very small percentage, a very small weighting. I mean, we're still very early days. And I mean, Bitcoin could go up in value 10x, which would take it from today's value of 100,000 up to $1 million a coin. And if it were to do so, it'd still only be 2% of total assets out there. It's got quite some way to run. And I think that's one of the things a lot of people have a hard time getting their head around. I mean, I know when I was buying it, I mean, Max Kaiser bought it at $2 and I was buying it at 400. So, everybody feels like they're too late. But if we're correct that, the fiat is slowly but surely getting debased and that this is a potential new monetary system, which I think it is, and my book talks about that, then you're really not too late. You just buy it and forget about it, hold on to it. And I think you'll wake up in 3 to 5 years. I mean, let's say in 5 years, it's $1 million a coin, which is kind of what I expect. 5 years.
Sure.
Well, anybody coming along looking at it then is going to say, back and I did a deep dive on monetary history and particularly with respect to the United States. And it's really kind of amazing how many times, they've done inflationary things. I mean, the story of the War of 1812, the story of, the Civil War and Lincoln issuing greenbacks, the story of World War II, where they printed a ton of money and the price level doubled in 6 years.
Yes.
So there's a lot of, it's not just, inflation is not something that's just new. It didn't just pop out of the ground. I mean, there are, people like Daniel Webster who said, inflation is the way that rich men, they fertilize their soil with the sweat off of the poor man's brow through inflation. So this was in the middle 1800s. So it's not like this problem is new. So there's a lot of fun stuff I found there. I also found a lot of corruption and told a little bit about some of that corruption and kind of pointed out. I mean, again, the book is trying to energize people to understand why the system is broken. And then given that the system is broken, what they need to do to, advocate to, one, protect themselves, but also, to think about this politically.